Welcome back to the Deep Dive. It is Wednesday, January 28th, 2026. And if you have been glued to the ticker tape today, you probably feel like you've been standing on a launch pad during a triple liftoff.
That's an understatement. I mean, we've seen days where the market creeps up, and we've seen days where it jumps today.
Yeah.
The computer hardware sector didn't just jump, it went vertical.
Yeah,
It's one of those sessions where you have to check if your screen is broken.
it really is wild. To give everyone the context, the Fed decided to keep rates steady today. And, usually that just sucks all the oxygen out of the room. Wall Street obsesses over every comma.
Oh, every single word.
But today, it's like nobody cares about the Fed. The entire story has shifted to this absolute melt-up we're seeing in hardware stocks.
It really highlights where we are in the cycle. We've moved past that software will save the world phase and landed squarely in the, well, we need physical stuff to actually run the software phase.
It's infrastructure.
Exactly. And that is creating massive bottlenecks. And where you have bottlenecks, you have massive winners.
It feels like a gold rush, but instead of pickaxes, it's all about mass-capacity hard drives and specialized 3D printing. So our mission today is to cut through all this noise. We ran the screener for the top 3 hardware stocks that are just, lighting up the market today. We're doing a deep dive into 3 names: Seagate Technology, Velo 3D, and Western Digital.
And this is a perfect set of companies because they each represent a really distinct psychological state of the market right now.
How so?
Well, you've got the proven giant that's delivering on its promises. Then you have the speculative, the retail-driven rocket ship. And then you have the sleeping giant that everyone's trying to get into before the big news drops.
Okay, so we're going to break down the news, the fundamentals, and the technicals. But we're also going to do something a little different today.
Yeah.
And honestly, a lot more fun. We're going to run a paper money math simulation.
I love this part.
We're going to pretend you dropped exactly $5,000 into each of these companies at specific times, and we'll calculate, exactly what that looks like in your pocket right now, because percentages are abstract.
But cash is reality.
Yeah.
It shows you the cost of inaction or the reward of patience in a way a chart just can't.
Before we start counting that imaginary cash, though, we do need to get the legal housekeeping out of the way. A quick reminder to you. We are observing data and reporting the news here.
Right.
We're not giving you financial advice. This is all for educational and entertainment purposes. So if you do want to invest your hard-earned capital, please consult a qualified professional first.
Absolutely. The market's moving fast, and as we'll see with at least one of these stocks, the risk is incredibly real.
All right, let's set the stage. The context for today is just a perfect storm. You got headlines floating around like Musk talks memory, which, triggers the algorithms.
Instantly.
You have a known supply crunch in global storage. And right at the epicenter of all this is our first stock, Seagate Technology, ticker STX.
The AI behemoth.
Seagate closed today at $442.93. That is up 19.14% in a single day.
Wow.
To put that in perspective, the stock moved $71 per share today.
For a legacy hardware company, that's just unheard of. You see moves like that in crypto or biotech penny stocks, maybe. But this is a massive company. A move like this signals a total repricing of the whole sector.
So what actually happened? Was this just hype, or is there some meat on the bone?
Oh, there is plenty of meat. The catalyst was their Q2 earnings report that came out yesterday. And to put it simply, they crushed it. But it wasn't just the beat. It was the forward guidance. The phrase that set Wall Street on fire was fully booked.
Okay, let's unpack that. Fully booked. What does that actually mean for the business?
It means their inventory for those AI-driven high-capacity drives is already spoken for. We are in a worsening global storage crunch. These AI models generate massive amounts of data, and that data has to physically live somewhere.
You can't just store it in the cloud, so to speak.
Right. The cloud is just someone else's hard drive. It needs a magnetic disk. And Seagate has the density tech, their HAMR tech heat-assisted magnetic recording, that lets them cram more data onto a disk than anyone else. They have the supply, and nobody else really does.
I saw the analyst community tripping over themselves this morning. It wasn't just polite applause. It was a scramble.
It was a total frenzy. You had 9 different analysts lifting their price targets. They had to chase the stock up. The big one was TD Cowen. They reiterated their buy and hiked their target all the way up to $500.
Wow.
When you see a target starting with a 5 on what used to be a boring old dividend stock, you know the whole paradigm has shifted.
Let's push back a little, though.
Yeah.
When a stock jumps 19% in a day, my alarm bells start ringing. I'm looking at the valuation and I'm thinking, this has to be a bubble.
Yeah.
The PE ratio is 50.1.
Right.
Historically, hardware trades at, what, 10 or 15 times earnings?
Exactly. Historically, 50 is an exorbitant price. You're paying $50 for every dollar of profit they're making right now. A strict value investor looking in the rearview mirror would sell immediately.
But the market's forward-looking.
The market is a forward-looking machine, so you have to look at the forward PE.
Which is?
If you look at the forward PE, which uses the estimated earnings for the next 12 months, it drops all the way down to 23.49.
Okay, that's a massive compression.
It is. It implies that analysts expect their earnings to basically double in the next year. So if you believe that growth story, paying 23 times forward earnings is, well, it's actually pretty reasonable for a tech monopoly in a growth cycle.
You're paying for tomorrow's orders.
The ones that are fully booked, exactly.
So is there a metric that tells us if they're actually running the business well, besides just raising prices?
Yes, and this is my favorite one for this sector. ROIC, return on invested capital. It's basically a measure of management's competence.
How good are they at turning a dollar of capital into profit?
You got it. And Seagate's ROIC is sitting at 49.75%.
That seems incredibly high.
It is elite. It means for every dollar they invest in factories or R&D, they're getting nearly 50 cents back in return. For a capital-intensive business like hardware manufacturing, that is just staggering efficiency.
So they're efficient, they're growing. I did notice the dividend yield is down to about 0.65%.
Yeah, the yield gets crushed when the price goes vertical. But let's be honest, no one is buying STX today for the dividend. They're here for the growth.
Okay, so the fundamentals are strong, even if the valuation is rich.
Yeah.
Let's look at the technicals. The chart it's a vertical line. It just smashed its previous high. Are there any warning signs flashing?
Oh, there are always warning signs in a move like this. The big one flashing red right now is the RSI, the Relative Strength Index.
Break that down for someone who doesn't stare at charts all day. What's the RSI telling us?
So RSI measures the speed and change of price movements on a scale of 0 to 100. Generally, anything over 70 is overbought. It means the buyers might be exhausted and the stock is due to cool off.
And Seagate's RSI is?
It's at 82.3.
That is hot.
It's scorching. Technically, it's screaming sell, or at least don't buy here. But, and this is a big but, in a momentum mania driven by something like AI, stocks can stay overbought for weeks.
Right.
If you sold NVIDIA every time the RSI hit 70, you'd have missed 90% of the move.
And the moving averages. I see the price is now 125% above its 200-day average. That feels stretched.
It is. It's like a rubber band stretched to its limit. Reversion to the mean is a real thing. But for now, momentum is king.
All right, let's make this real. It is time for our paper money math.
Let's run the numbers.
We're using the performance month metric for Seagate. The screener shows it's up 54.75% in just the last 30 days. So here's the scenario.
Yep.
You heard the rumors about the storage shortage a month ago. You put exactly $5,000 into STX.
Okay, the math is simple but beautiful. You take your $5,000 principal and you multiply it by 1.5475.
And what are we looking at?
That $5,000 is now worth $7,737.50.
So a profit of $2,737.
In 30 days.
That's basically a mortgage payment. Or a very nice vacation.
It really is. It shows the power of catching an earnings run-up. The buy trigger here was the anticipation of that beat, the sell trigger. Well, with that RSI at 82, a smart trader might be taking some of that 2,700 off the table right now.
Taking the win. I like it. Now, let's pivot. We're going from the king of AI storage to something. Well, let's call it the Wild West. Our second stock is Velo 3D, ticker VELO.
Yes, the retail rocket.
This stock also had a monster day. It closed at $16.63, up 18.79%. But this isn't a huge company like Seagate. This is a small cap. What lit the fuse here?
This was a classic sentiment surge. The catalyst wasn't an earnings report. It was a tweet. The CEO tweeted, teasing major upcoming wins. In this market, that's like a lit match in a powder keg.
But it's not just a tweet, right? There's some narrative to back it
So
up.
there's context. Earlier in January, we saw reports that Cathie Wood opened a new stake. And there have been headlines about partnerships with the U.S. Army. So the story is, defense spending meets 3D printing meets a celebrity investor.
That sounds great on paper, but I'm looking at the fundamentals here, and Unlike Seagate, these numbers look scary.
They are objectively terrifying if you care about traditional valuation.
I'm seeing negative earnings. EPS is negative 16.33.
Correct. They're losing money on every share.
And the margins.
The gross margin is negative 1.83%. That means it literally costs them more to make their printers than they sell them for.
Wow.
And the operating margin is negative 114%. They are burning cash at an alarming rate.
Okay, wait. They lose money making the product? They lose money running the company. Why on earth is the stock up almost 19% today?
2 words. Short squeeze. This is the absolute critical data point for Velo. The short float is 77.73%.
Oh, explain that. I know what a short is, but 77%.
It's an astronomical number. Usually a high short interest is maybe, 10 or 15%. This is 77%. It means nearly 80% of the tradable shares have been borrowed and sold by investors, betting the stock will go to zero.
They're betting on bankruptcy.
They are. But when positive news hits, like a CEO tweet, the price bumps up. And those short sellers start losing money instantly.
So to stop the bleeding, they have to buy the stock back.
Exactly. They have to cover their positions. And their buying drives the price up even further, which forces more shorts to panic and buy. It's a feedback loop. Today's move wasn't about the business. It was about market mechanics. It was a squeeze.
So it's a battleground. And looking at the technicals, the volatility is insane. The 52-week low was $1.42. Today, it's over $16. That's a 1,000% move from the bottom.
And the beta is 1.97. It's almost twice as volatile as the market. If the S&P sneezes, Velo catches the flu.
So if Seagate is an investment, Velo 3D is a gamble.
It's a casino. The buy trigger is pure momentum. But the sell trigger is the financials. If the liquidity dries up, this stock has no floor.
High risk, high reward. Let's do the math on this roller coaster. For Velo, we're going to look at the performance quarter. The screener says it's up 154% in the last 3 months.
This is going to be a big number.
Okay, scenario. You saw the bottom forming 3 months ago. You threw $5,000 of fund money at Velo, knowing you might lose it all.
All right, math time. $5,000 investment. A 154% gain means we're multiplying by roughly 2.54.
In the result,
Your $5,000 is now worth $12,714.
my profit of over $7,700.
In 3 months. You more than doubled your money.
That's the allure. That's why people chase these things.
It is. But you have to remember survivorship bias here. For every Velo that's squeezed, there are 5 others with negative margins that just went to zero. You made $7,000 here, but the risk of losing that initial $5,000 was extremely high.
Point taken. All right, let's move to our third and final stock. This one feels like a bridge between the first two. It's Western Digital, ticker WDC.
The sympathy play.
Exactly. WDC closed at $279.70, up over 10% today. But here's the kicker. They haven't even reported earnings yet.
No, and that's what makes this so interesting. They report tomorrow morning. Today's move was almost entirely because of Seagate. Investors saw Seagate smash earnings and just assumed, well, if the storage market is hot for them, it must be hot for Western Digital too.
A rising tide lifts all hard drives.
Precisely. Plus, you had that Barron's headline, Musk talks memory. Western Digital makes both hard drives like Seagate and also flash memory. So when Musk talks memory, WDC gets a boost.
Let's look at the value here. Seagate's PE was 50. Western Digital is sitting at a PE of around 40. So it's cheaper.
It is cheaper, but the real gem here, the number that has value investors drooling, is the PEG ratio. It's at 0.73.
I feel like PEG is one of those acronyms people hear but don't fully grasp. Why is 0.73 so important?
PEG stands for price to earnings growth. It's a way to contextualize the price tag. It compares the valuation to how fast the company is growing. A PEG of 1 is considered fair value.
So anything under 1 is a discount.
Exactly. Anything under 1 suggests the stock is actually undervalued relative to its future growth. A 0.73 is a screaming buy signal to a growth at a reasonable price investor. It implies the price hasn't actually caught up to the growth rate yet.
And they are profitable. EPS this year is up over 60%.
They've turned the ship around. They're capitalizing on the same AI demand that Seagate is, but because they also have that flash memory business, which is more cyclical, the market's been a bit slower to give them full credit.
The technicals look strong, too. Strong, steady uptrend. The RSI is at 79.12.
Again, overbought, but a little less heated than Seagate. But entering an earnings call with an RSI of 79 is dangerous.
Why is that dangerous? Isn't momentum good?
It is, but expectations are now sky high. The stock is priced for perfection. If they report tomorrow and the numbers are just good and not God tier, the stock could drop 10% instantly. The market is demanding a blowout.
That creates a lot of tension for tomorrow morning. But let's look at the long game. For our final paper money math challenge, we are going to zoom out. We're using the performance year metric for Western Digital.
This is the one that really matters.
The screener shows WDC is up 474.78% over the last year.
So, the scenario. 1 year ago, January 2025, you decided data storage was the bottleneck. You put $5,000 into WDC and you just forgot about it.
Let's do the math. $5,000 investment, a 474% gain. So we're multiplying by roughly 5.75.
Yeah, and the grand total,
Your $5,000 is now sitting at $28,739
a profit of $23,739.
in 1 year.
That blows the other two completely out of the water.
It really does. And it proves an old adage. The Velo trade was exciting. The Seagate trade paid the mortgage. But simply identifying a macro trend and holding a solid, undervalued company for a year, that was the life-changing trade. Over $23,000 in profit. Incredible. So let's wrap this up. We have 3 distinct flavors today.
We do. Seagate, the proven winner. They showed the earnings, they proved the demand is real.
Then we have Velo 3D, the short squeeze rocket.
Pure speculation, retail frenzy, negative margins. It's a fun ride, but bring a parachute.
And finally, Western Digital, the value anticipation play.
The one with the best long-term return on paper, but facing its biggest test tomorrow morning.
It is going to be a fascinating morning. But I want to leave you with a thought. We're looking at RSIs over 80. We're looking at stocks jumping 20% in a day on Sympathy.
It raises the big question.
Are we looking at a sustainable build-out of AI infrastructure that justifies these valuations? Or have we officially entered a melt-up bubble where the fundamentals simply don't matter anymore until the music stops?
When you see massive companies moving like penny stocks, you have to ask if the market is pricing in reality or if it's just pricing in hope. The line is getting very blurry.
Something to mull over? Make sure to check the sources we've provided for the full data. Good luck navigating the volatility.
Stay sharp out there.
Thanks for listening to The Deep Dive. We'll catch you next time.